Good evening and welcome to Personal Finance. I'm Dumisho Greater, standing in for Gugulethu Cele. Despite South Africa's financial markets having weathered the global economic crisis, the economy has not emerged unscathed. That's with the reality of retrenchment that's hit home. Nick Decker, he's a financial planner at Ultima Financial Planners, joins me for more. Nick, thanks so much. But firstly, I think let's make a distinction between being fired and being retrenched.
Yes, there are three legal ways of dismissing a person. One is for misconduct, when you don't obey the rules of your employer, and those can be industry specific. Another is if you are incapable to do your job, if you just cannot perform the duties of what's required of you. The second one is for operational reasons, where a company, for whatever reason, needs to cut down on the employees. Maybe it was a takeover by another company and now it's new management taking over and so on. And that is where you get retrenchment. So those are the three main reasons.
As a financial planner, I'm sure you see a lot of these people walk through your doors. They must be emotionally distraught. So what are the very first things that you tell them? What should they do?
Well, first of all is to get an action plan together. The problem is with retrenchment, it causes that emotional distress, and emotions leads people to do irrational things. And it's to get outside expert advice of someone independent who can help you put a structured plan in place in order to manage your financial affairs when that dear thing happens to you.
So what are the first things that I can implement before, when I do come and see a financial planner? What can I expect you to say? What are the typical things that you would advise them to do?
I would say first, reconsider your budget. Often, if you look at your budget critically, there are some luxury items that you can cut down on. I'm thinking short-term insurance. I don't say stop your short-term insurance, but one thing that people don't realize is that if you increase your voluntary payments for a claim, you can reduce your premiums quite a lot. An example, if I insure my car for 100,000 and I have a voluntary co-payment of 10,000, I'm actually insured for 90,000, so I'm covered for the highest, for the greater of the risk. But my monthly installments may come down drastically. That's one way. I know you're a paying TV station, but another luxury item is pay TV, something like DSTV, which is quite a big expense in many households, and other entertainment. So first of all, reconsider your budget and cut it down to the bare minimum. And then look at your resources. What do I have in terms of UIF, Unemployment Insurance Fund, other investments? If it was retrenchment, often there's a pension fund which you may gain access to, and other, and take into account the balance of the two. How can I use those resources sparingly enough in order to cover for my day-to-day and not dreadfully harm my long-term expectations as well?
What about these tax-free savings that we've heard about? Every time I'll hear tax-free, now that I'm retrenched, this is something I'd want to take full advantage of. Would this be an avenue for me to put my money away in?
It would be something where you put your money away, but normally when you're in this situation, the problem, well, let's first of all start with the problem with the tax-free savings is you are limited to the amount that you can contribute to within one specific tax year. And if you withdraw, you cannot put the money back. It's a once-off withdrawal. If you want to put it back, it will be taxed. It will be taxed very harshly. So it's not something that I would consider immediately.
So if I already have a lump sum payment that I get from my employer, if I don't take it all out, I would have two more options, putting it in a preservation fund, one would assume, or putting it away in a retirement annuity. What are the differences between the two, and how can I make sure that I maximize, that I don't have as much tax burden?
So let's assume the employer who retrenched you did provide you with a company pension or provident fund. With most of them, you have the option to reinvest either into a retirement annuity or a preservation fund. And the main difference between the two is with a retirement annuity, you cannot have access to those funds before age 55. That's current legislation. which may change in a year's time, but we don't have certainty on that. Whereas if you have the money in a preservation fund, you have a once-off access to the funds, either partially or wholly. And once you've gained access to those funds, well, tax will be deducted, but once you've withdrawn, you don't have the option again until retirement. But it at least gives you that back door to do have access when you really need the money.
So you put your budgets together, so you basically know how much you're going to need every single month.
Yes.
You've gone to see a financial planner. You know of the options of either a retirement annuity or a provident fund. There are tax saving investments. What tax-free savings investments? What happens if I'm already over the age of 55 and I'm already considered too old to maybe get into the job market?
There's an interesting phenomenon in Europe called the grey factor, where many of the baby boomers who now past their normal retirement date, but they have a wealth of knowledge and experience, and also in many instances they do have some cash available, but they don't want to sit at home and do nothing. They start up new businesses and can actually employ new people. So it's not a bad idea to think outside the box and not only look for alternative employment, but maybe consider something that you like. You can make a profitable hobby and make it a good business.
There are these products on the market, Nick, income protection plans, loan protectors. If you're in a position in which you're not yet retrenched, but you're still employed, should I be taking out these, these products that are available to make sure that in the event that this does happen, that I'm at least protected?
Yes, definitely that's an option. Many of the insurance companies offer products, retrenchment cover options, but they are quite strict in their wording. For instance, some industries do not qualify, and some specific job descriptions also do not qualify. They are automatically disqualified. Directors, for instance, of companies will not be covered by such a policy. But there are those options for ensuring a retrenchment.
So what's the best solution now? Should you be going through reading the fine print, making sure that your income will be protected, or how much money should I be setting aside in the event that I do lose my job?
Well, it's a difficult question to answer as a blanket, because each and every person's situation will be different on that. It will depend on how much savings to have I set aside, which can carry me for a month or 2 or 3, maybe a year, if I don't have lots of debt and I don't have children at home which I have to look at their school fees and so on. If I travel light in terms of my budget, you don't need a lot in order to be to survive. Whereas if you have lots of debt, you may need more funds in order to sustain yourself, and then something like an insurance product with a solution for that may be beneficial. So it's not just an easy answer to give as a blanket.
This might also be another blanket question, but if you had to weigh on the ratio of your income to your debt, even before or after, what would be a comfortable ratio to have to say to yourself, should anything happen, I might be able to survive for the next 6 months or so?
If you have no debt and you have, I mean, that's the ideal situation.
Yes.
Would I pay off debt with, let's call it a severance package or a retrenchment benefit? It's also a difficult question, because it's not wrong to repay debt. But if, for instance, using the example of 100,000 again, if my monthly expenses are 10,000, with 100,000 I can sustain my income for the next 10 months. Whereas if I only repay my debt, I only take away a portion of my budgetary requirements, so I still need to get the rest from somewhere else. So is that answering your question?
Yeah, well, a little bit. You carry on.
Yeah. So again, there are various strategies. I think the important thing again is, for someone in that situation being overwhelmed with emotion, to get that outside expert advice from someone who's not emotionally attached, who can give you that guidance. Example I used earlier is, if I'm on a strict diet and there's a table of food lying in front of me, I know what the right thing is to do, not to overindulge in those delicious, nice, sweet and tasty food, but to eat only what is really required. And the same is, sometimes the answers are not revolutionary. It may be common sense,
Yes.
but it's not easy to take at that specific point in time.
So a short answer to that is make sure that you stick to that diet.
Stick to your diet. First of all, get a financial plan and stick to it.
Let's recap the key takeaways from this discussion. So Nick, if there was anything to be said from this, what would the key things be?
I would say, first of all, with all financial plans is live within your means while employed, so that also it's easier. Well, you don't have to take such a drastic cut in lifestyle if something dreadful happens to your employment.
There you have it. That's the advice from Nick Decker, saying live within your means and also stick to that diet when it comes to being financially frugal. That's it for this edition of Personal Finance this evening. Thank you once again to Nick Decker from Ultima Financial Planners. Remember that we'd love to hear from you, so you can tweet us or send us your comments to @CNBC Africa, and you can use the hashtag Finance410. From me, Tumisho Greater, and the team, have a great evening.